I think Sonia, you'll have to pick up.
Okay. Well, for the market, it is, as of now, doing pretty well. So up 150 points on the Nifty, Sensex up almost about 500 points. Good time to get in our expert for the day, Vikash Kumar Jain, who's the investment analyst at CLSA, joins us now to talk about the market, all that's been happening so far in different stocks and sectors as well. Vikash, welcome to the show. Thanks a lot for being with us. Do you see this market continue to trend lower, both globally and in a market like India? Yes, India has outperformed, but do you think that this rally can pause further for now?
Hi, thanks for having me. So the way to look about that is, when we look at various metrics, and in fact, we've come out with a note just today itself, we are struggling to find any margin of safety in the market. So just yesterday, as US bond yields went higher, Indian bond yields hardly reacted. What that has done is the differential between US and Indian bond yield has fallen to the lowest level in the last 13 years of about a little over 3 percentage points or so. Now, US bonds are considered to be the safest haven assets in the world, or the largest and the most liquid safe haven assets in the world. Simply put, there are various things which will go into determining this difference, but simply put, what the market seems to be suggesting is that rupee depreciation itself is likely to be 3% or lower on an annual average basis from here on for the next 10 years. We, historically over the last 3 to 5 years or 10 years, the average has been anywhere between 4 to 5% annual depreciation in INR. So just that makes us a little unsure on whether that 3% is something which is likely. Plus, the fact is that our forex reserves have also kind of come down to levels where we are covering only 9 months of import cover. Historically, going below 8 months has not been very, has been a little bit of a worry for the currency itself. So we're not feeling that we are in such a situation that we can get very comfortable about the currency being depreciating far less than what it has done in the last 5-10 years. Secondly, if we also look at the differential between bond and equity valuations, so that is something which is already at its higher extreme. So historically above 2% or so, whenever one has invested money in equities, they've ended up losing money. So we are already at about 2% difference between 10-year bond yield of India and equity earnings yield of India. So essentially, basically, we have completely eaten out or extended ourselves both on the differential versus the bonds in the US, as well as our own equity valuations versus our own debt valuations. Historically, wherever we are right now in terms of our bond equity valuation differential or absolute PE has not delivered positive returns. So basically, we are at levels which has very limited margin of safety, and history is stacked against us to get significant positive returns. So absolute positive returns and large positive returns from here on over the next 12-15 months or so looks very difficult on the index.
The 5 most dangerous words in finance. Could this time be different, Vikash?
Well, I hope so, and I hope that I'm wrong. But essentially, a lot of things have to be different from that perspective. So what are the things which have to be different? Number one, our currency has to be far more resilient. Number two, suddenly people have to start realizing that perhaps Indian bonds are way more safer than US bonds. And thirdly, suddenly people have to start believing that, the growth that is offered by Indian equities will be far higher than any time in the past that Indian equities have offered, and therefore ignore the bond yields at all. So, I'm not betting on all of that, but those are just a list out. What are the things that need to be very different for, this view to be wrong?
So this is a macro call, or you're kind of modeling that into how earnings will come under pressure because of all of this, and how does this kind of feed in, or these are just macro indicators and you kind of flip negative or positive based on them? I mean, at a time like this, right now, for now.
This is a macro call on the market. We're not going into specific stocks and earnings of that. Now, these assumptions, just to kind of give you a sense. At a point when US yields have gone up by 150 bips in the last, 2 months or so, essentially, if you were to turn back and ask me what is needed, we were at about 18,000 very recently. What is needed for the market to go up to 19,000 or so, or 19,500 plus, say by March? I think Indian bond yields have to come down to 7%. Okay. Number two, earnings, earnings should not be downgraded from here on. And number three, we should be able to keep trading at the upper band of this differential between equity and bond yield, which we are anyways been flirting with over the last 2 months or so. So essentially, all of those picture perfect things need to play out for us to get 15% return, from here till March. So essentially, it's a tough one, simply put.
Okay, it's a tough one. Let's do one thing. Let's talk about sectors, right? Because there's so much that's happened, for example, in the cement space recently with Adani's investment there. You guys at CLSA upgraded ACC to an outperform just a while back. Tell us about how the dynamics of the industry could change post this large entrant, and what do you do if you're a holder in cement stocks?
So, see, this large entrant, without getting into specific stocks and names, clearly appears to be wanting to take a bigger share of the pie. Now, if that could come through both both organic as well as inorganic means. If it is organic means itself, which is what the large entrant appears to be banking on, then that will mean a much bigger increase in capacity. So from a competitive intensity perspective as well as a demand supply perspective, it will become a more difficult sector than what it was before that. So from that perspective, we do not really have any strong bias in the sector.
Are you, Vikas, I mean, across your team at CLSA, which team exudes the most confidence about future returns right now? Is it the banking team? Is it it's a sector question, basically?
So simply put, see, I think we are still not sure. If we were to look at the US, the real yields in the US, that is, say if you were to look at the 10-year yield minus CPI or the Fed fund rate minus CPI, these are at 50 to 60-year lows. These are the lowest levels we've seen since at least 1960s or so. I was actually recently in the US, and if you go to, you don't really feel like you are in an economy which is in recession. Activity over there and demand over there seems to be pretty robust. So, and the Fed governor recently said that they're actively looking at bringing down, raising unemployment to a level which is more sustainable versus the record low levels that it is right now. I think, and the one thing that I was able to notice is that clearly there is still a significant job openings which were there, which you could figure out just kind of walking on the street. So from that perspective, and the fact that real rates are so negative, makes us actually worry that Fed could actually continue hiking. So we are in a rising yield environment. In India, so far, balance sheet concerns do not really look that big. So from that perspective, if you're in a rising yield environment and balance sheet concerns aren't really there, then banks should continue to be the preferred bet. And that's something that we've liked for a while. We continue to keep that as our favorite sector in the large cap space.
Well, let me answer Prashant's question for you, right? There's, apart from banking, there's also the hydropower sector that you like, if I'm not wrong. Recently, you all initiated a buy on SJVN, on NHPC, and this renewable energy space is coming up in a big way, but there are problems that these companies face as well. Do you think this is, the up-and-coming space for investors to look at?
So, I mean, that report that my colleague recently published, a pretty big 250-page report, where we talked about that hydro is honestly India's answer to its longer-term green goals in terms of getting to net zero. And hydro could actually, he kind of makes an interesting case on hydro should be used as a way to be considered as what batteries can do in terms of power storage. That's something which can be done by hydro. So that is a very interesting piece for our clients to read. And, we believe that over the longer term, when people are looking at green plays or plays to new energy, even hydro stocks appear to be interesting ones.
All right, we'll leave it there. Vikas, thanks very much. Great speaking with you as always. And Vikas, of course, I mean, is not very positive in terms of prospects for the market overall. at this point in time. But, let's get back to some of the local domestic-oriented sectors and what's happening there. And let's talk about the commercial vehicle space in terms of financing. We have the management of Sundar Finance with us. Rajiv Lochan is managing director of the company, and he's joining us for a quick conversation on how the CV cycle performance is panning out. Mr. Lochan, thank you very much. Great to have you with us here. Thank you very much. We've heard so much from different companies we speak with, how things are picking up and things are on an up and up as far as commercial vehicle space is concerned. Could you put some numbers to that in terms of dispersals from your end in Q2 so far? How is that stacking up as compared to previous quarters?
Good morning, Prashant. Thanks so much for having us on the show. It's certainly, as we get into the festival season, the mood is positive in general, as it should be. Over the last quarter, I think we've seen significant movement in different subsegments of the commercial vehicles. I think buses were, in a sense, the first to get off the blocks, starting with school buses and then subsequently staff buses and more recently route buses. That's a segment that, as you know, over the last couple of years has been quite muted given all the vagaries of the pandemic that we've had to deal with. So a lot of buoyancy in that space. Tippers have remained, I think, quite robust right through, and that story has continued through the last 2 or 3 months, I would say. The one that I think we track quite closely also is the haulage, and in many ways that tracks the economic activity within the country. And over the last 3-4 months, the activity has remained quite robust and steady. All indicators that I'm sure you track and we track, around diesel consumption, around e-way bills, around toll collections and so forth are all trending up in the right direction. And so that has reflected in the haulage growth as well. If I just unpack that one level, I think it's mostly been 2 drivers. One, replacement demand across all these, but also GST-related buying that some of the larger fleet operators have planned for and executed. So this past 2 quarters, I would say commercial vehicles is certainly on the upcycle. External complications, that are beyond the control of the local economy, whether it is sort of geopolitical complications, monetary policy actions by central banks around the world have an impact. But structurally, what we're seeing is a bounce back up on that upcycle of the CV space that we've been waiting for some time now. And there are clear signals of that happening quite systematically.
That was my next question, Mr. Lochan. Generally, when a CV upcycle starts, it lasts for about 2 to 3 years. At what stage of this upcycle are we in right now, if you had to sort of gauge the trend?
Yeah, we've been bottom fishing for a while, Sonia. And I would request all of you to please call me Rajiv as opposed to Mr. Lochan, which seems just too formal. But we've been bottom fishing for a while, and multiple factors have sort of compounded that over the last, I'd say, 4 to 6 quarters. My sense is we're probably at the early stages of the upcycle, which over the next 2 to 3 years, we should expect to sustain and continue. I expect that the dynamics across the various subsegments, buses, tippers and haulage might be slightly different as we go forward, as also the mix between replacement buying and expansion. So some of those dynamics might influence how long it lasts and how steep the recovery is. But to answer your specific question, Sonia, we're probably in the early stages of the upcycle that we're seeing right now.
Mm-hmm. How's sort of asset quality holding up, Rajiv? I mean, if you can give us some sense.
Well, asset quality has been improving quarter on quarter quite systematically, Prashant. And I think the circular from the Reserve Bank on asset quality, which came in November, has actually for us been quite a boon, because what that has essentially allowed us to do is to enforce the discipline of the fixed billing dates, as we call it, for repayments. And our customers have adapted well. Our people have adapted well. And on the back of that, the discipline of honoring the due dates is beginning to fall in place. We've seen consistent improvements in our own asset quality over the last 4 to 6 quarters, and that trend is holding up quite well. We're quite pleased with the best-in-class asset quality that we currently enjoy.
Okay. Any disbursement growth targets that you have for the full year? I mean, in the quarter gone by, of course, it looked exceptionally good year on year because of the low base. But what is the target that you can achieve by the end of the year?
Yeah, so growth is something that's not entirely in our control, Sonia, and particularly given some of the complications that we're facing, just given how the external environment is just now. what we tend to focus on is a lot more on market share, which we think is much more within our control and influence. And so our ambition is to retain our market share, particularly in the medium and heavy commercial segment, and in the retail commercial segment, which is intermediate commercials, light commercial, and small commercial vehicles, actually build our share to a double-digit kind of level is where aspirationally we'd like to get. There's also other asset classes in our mix, which gives us a diversification benefit. As we get into the tractor season now, tractors are a very important and interesting portfolio. We are seeing rural sentiment pick up quite nicely. And again, there we'd like to establish a decent market share. So our growth is in some sense imputed from the market share we'd like to get to.
Rajiv, what's your liability mix like? And, you know, rates are going up. I mean, tomorrow we've got an RBI policy where they will have to hike by, according to, you know, economists, at least by 50 basis points, and maybe have to do more later because of what's happening globally, not so much here. What does that do to, you know, a cost of funds for you? And eventually, I mean, that'll seep through everywhere, margins, etc.
That's absolutely right, Prashant. I think the rate hikes, of course, are quite warranted given the inflation pressures we've seen. And, you know, our liability mix tends to be, you know, predominantly towards market, capital markets. So we borrow NCDs and commercial paper. That's the majority. We also have term loans from banks. That's another good chunk. And then, of course, we are a deposit-taking NBFC. So we have 12 to 15% of our liabilities coming from deposits. So that's the broad liability mix. And as you rightly mentioned, given the rate hikes, we've seen sort of a natural increase in our borrowing costs getting transmitted. And so what we have to be smart about, I think, looking ahead is plan for a return to the pre-COVID margin levels. I think the excesses, if I can say that, over the last couple of years that the globe has seen in terms of just money printing that happened globally that found its way here, provided a little bit of a...
Oops, okay, I think there's some issue with your audio, but we will leave it at that. Thanks a lot for joining us and giving us an update. So that's, I mean, it's reflected in the stock as well, right? Just pull up a 3-month chart of Sundaram Finance. The going has been very good. It's been in excess of 20%, the gains on the stock, and the company says that demand is picking up in a big way, and this is the start of an upcycle, a multi-year upcycle in the commercial vehicle sector. Let's slip into a quick break. Up next, Mitesh Thakkar will join in for some technical trades. Stay tuned.
Okay, welcome back. You know, we were up 150, then lost 40, then gained 40, and we've lost 40 again. So 110 points roughly on the index, just under 17,000 is where we are at. Mitesh Thakkar is with us to run us through, you know, what he would do now. Mitesh, good to have you back. Is there a sort of upward bias, downward bias? What would you want to do? Sell the rallies or try and buy the dips?
Prashant, my sense is that I think, you know, on the index, we'll possibly get into a consolidation. So we are somewhere in the middle of the range right now, around 17,000 mark. I think 16,750, 17,200, 250 is my broad understanding of the range. Therefore, I think, you know, you would want to trade once you're near the edges. So maybe around 16,800, 820 zones you would want to buy. Closer to 17,200 you would want to sell. So that's the way we'll approach the index. For the timing, trading is more stock specific, and I have 2 buy calls. MGL has broken out on the upside. So keep a stop at 865, look for targets of 920 here. And the other one is Aditya Birla Fashion, ABFRL. That's a buy as well with the stop below 329 for targets of 350.
That's MGL. By the way, Tata Chemicals, that stock we were just referring to in pre-opening as well, up 6.5% now on that Morgan Stanley double upgrade. So keep an eye out on that name. But shifting focus to the commodity markets, we have Manisha Gupta joining in to give us a quick word on that. Manisha, what are you tracking now?
Sonia, I'm looking at the gold prices because a very smart rebound is what we are dealing with in the overnight markets. 2% up, which has been the biggest day gain that we have seen come in for last 2 months, really. And the prices did see all the way up to $1,660 per ounce on the higher side after hitting a low of $1,615 on the weaker side. So it has been a good $40, $45 of a jump up from the intraday lows that we put in case of the gold prices yesterday. A couple of factors which have been supportive. As I said, this has been the biggest one-day gain in 2 months that we've seen come in case of the gold prices. The gains have come in as we have seen a decline in US dollar. But even with the kind of gains that we are working with, the gold is still headed for a sixth monthly decline, that is. The dollar index, after hitting 114.6 kind of levels on the higher side, not only broke below 114, but 113 also at one point in time is when we saw those gains come in for the gold prices. Also, the bearish bets are the highest in last 4 years. So there has been some squeeze, some binding of positions also that the gold prices seem to be dealing with. The US pending house sales were down 2% in the month of August. So all the economic data continues to be on the weaker side. That in turn has led to some buying in case of gold. The Bank of England has started new emergency quantitative easing. So there is more money, easy money coming in, at least in UK. That also in some sense supported the gold prices. But having said that, it really is going to be about the US GDP data, which the markets are awaiting right now. Minus 0.6% has been factored in. Anything less than that is something that could actually be yet another reason for the gold prices to gain up. If you look at the range that we've seen in case of gold prices in the international markets, we're down by 9% in current year, and the range has been from 2052 of a high to around 1615, a level that we saw in the markets yesterday. For the Indian markets, because of the rupee depreciation, this range has been cushioned. So we are down just about 1.5% in this current year, but the range has been huge, almost like 6,000 to 7,000 rupees, from 55,000 on the higher side to 47,000 on the lower side, currently just about holding close to that 50,000 rupees per 10 grams there. More importantly, on how gold prices are going to perform going forward, there is still some bearishness here. Swiss Quote expects the gold prices to test $1,600 per ounce on the lower side. You have similar views coming in from TD and Bank of America as well. RBC, for one, expects the gold prices to go down to 1663 by the end of this year. But they are bullish going forward and they expect higher prices. ING as well expects this year to end by 1650, but for next year they expect 1900 kind of levels as well coming in. That's a similar view that we have seen, as I said, coming in from other banks as well. BMO Capital Markets, 1649 is what they see as an average for the next year as well. So this year and the first half of next year, the gold prices actually could be cut in a range.
Okay, thanks a lot, Manisha, for that. But back to equities now. A lot of stocks are buzzing around. Tata Chemicals, as I told you, is the big gainer. SRF is also buzzing in trade. Nimesh is here to tell us why, in case you missed that one. Nimesh.
Hi Sonia. So as you rightly pointed out, a big reaction to the specialty chemical stocks on the back of a big report from Morgan Stanley. The biggest mover has been Tata Chemicals, up 7%, largely on back of Morgan Stanley double upgrading the stock to overweight from underweight, and there they've sharply raised the target price to 13.19. On the other side, they have double downgraded Aarti Industries to underweight from overweight, and they've cut the target price there to 685, and maybe that's the reason why that stock is down 2%. The other downgrade came in Deepak Nitrite from equal weight to underweight, and Deepak Nitrite, they've cut the target price to 1732. SRF remains the top pick in the specialty chemical space for Morgan Stanley, and there they've sharply raised the target price now to 35.71. So big upgrades and downgrades in the chemical space. Now coming to specific companies on Aarti Industries, the downgrade is largely because it's reflecting raw material constraints and slower project ramp up for Aarti Industries. So that's the key reason for the big downgrade. On Deepak Nitrite, Morgan Stanley sees a limited visibility on phenol and demand risk in key segments. That's the reason why they've downgraded notch to underweight for Deepak Nitrite. However, the biggest upgrade is on Tata Chemicals, and that's largely because of limited tightness in the soda ash segment, as well as the fact that the company has been doing cost controls, and that's where a big upgrade has come on Tata Chemicals. Overall, for the industry, Morgan Stanley is seeing a $25 billion value creation opportunity over the next 3-4 years until 2025. And while all these companies will not only benefit from supply shift from China, but also these companies will benefit now from Europe One, because there's going to be a lot of shift to the Indian companies from Europe. So that's the key reason big upgrades have come in. For the next 3 years, Morgan Stanley is expecting a 22% profit CAGR for all these chemical companies, despite the fact that there's going to be some demand slowdown, and some key products will be under margin pressure. Having said that, the two big reactions is on Tata Chemical, a double upgrade, and on Aarti Industries, a double downgrade from Morgan Stanley.
Right, Nimesh, thank you very much. The big movers today at the back of brokerage calls which are coming through. All right, what we'll do is we'll take a very quick break here, and on the other side, our special segment, Indianomics. Lata will get chatting with the former RBI Governor D. Subbarao on the rupee trajectory and what to expect from the RBI policy. Stay tuned for that.